The year 2026 brings a fog of economic uncertainty. Some experts see smooth sailing, pointing to fiscal stimulus and continued growth. But that ignores dangerous undercurrents. JP Morgan Chase still sees a 40% probability of a U.S. recession. I have personally warned we are very close to a recession or something worse. We are witnessing a classic breakdown of the major monetary and political orders. These shifts happen only once in a lifetime. The global economy is balanced on a knife's edge. The coming downturn isn't a single problem, but a perfect storm created by three massive, overinflated bubbles. The first is the housing market, where skyrocketing prices mean a significant drop is the only way to restore affordability. The second is the AI tech bubble, where immense hype has led to questionable valuations. Finally, the stock market itself, where some analysts predict the worst crash in history. These bubbles are deeply intertwined. A crash in one could trigger a devastating chain reaction across the entire economy. The American dream of homeownership has become a financial nightmare for many. For years, we've watched home prices climb to dizzying heights, completely decoupling from median household incomes. This isn't sustainable. It's a classic bubble. Prices have risen far faster than wages. A recent analysis confirms the grim outlook. Even with projected wage growth and slightly lower mortgage rates, affordability is unlikely to return. This creates a dangerous illusion of wealth. Homeowners feel richer on paper, but can't actually pay their bills. The system is stretched thin, waiting to snap. Years of historically low interest rates papered over the crisis. Low rates made huge mortgages seem manageable, pushing people to stretch their budgets just to get on the property ladder. Now that era is over. The Fed raised rates to fight inflation, and small cuts won't bring back rock-bottom borrowing costs. Higher borrowing costs hit buyers and refinancers. Many owners are locked into low-rate loans, unwilling to sell, shrinking supply. The market is trapped. High prices and high mortgage rates have crushed buyer demand. Yet prices haven't fallen much. Sellers, many locked into low rates, are refusing to lower prices. This lock-in effect freezes the market. It can't hold forever. Something has to give. Recovery won't come from wage miracles, but from a painful drop in home prices. Younger generations and first-time buyers take the hit. They're priced out in major cities. They're forced to rent where rents are inflated, and saving for a down payment is nearly impossible. This delays family formation, reduces household wealth accumulation, and creates a deepening sense of economic disenfranchisement. The social fabric is strained when home ownership becomes an impossible dream. This is a societal problem. Its fallout will last a generation. A bubble doesn't burst on its own. It needs a trigger, a pin to prick the overinflated balloon. Several triggers are lining up, from widespread job losses to the shock of mortgage payments resetting at far higher rates. As market psychology shifts from FOMO to fear, buyers retreat, creating a self-reinforcing downward spiral. A housing crash is never a contained event. The ripples spread far and wide, touching every corner of the economy. As home values plummet, household wealth evaporates. This negative wealth effect causes people to pull back sharply on spending. The next ripple hits the financial sector. When homeowners default, banks face massive losses and stop lending, creating a credit crunch that starves the economy. This leads to massive layoffs in construction and other industries, deepening the economic downturn. Not all housing markets are created equal. The cities at highest risk are those that saw extreme price appreciation fueled by speculation, like pandemic boom towns, Austin, Boise, and Phoenix. A key indicator is the price-to-income ratio. In a healthy market, it's 3 to 4 times income. In at-risk cities, it has soared to 8, 9, or even 10. This is a clear red flag that prices are detached from what locals can afford. Don't be swayed by national headlines. Dig into the data for your own city. The impending housing bust shares similarities with 2008, a bubble fueled by cheap debt. But there are critical differences. And in 2008, the problem was subprime mortgages. Today, it's not bad borrowers, but good borrowers vulnerable to interest rate hikes. And unlike 2008, massive national debt and persistent inflation mean the government and Fed cannot ride to the rescue. We have the speculative excess of the past, but without the policy tools to fight the fire. First up, the mania of the machines. The narrative driving the markets today is AI, a frenzy rivaling the dot-com boom. Hype and a fear of missing out have propelled tech stocks to astronomical valuations, far beyond what current earnings can justify. But the market has a history of getting carried away. The path from a promising demo to a profitable product is long and treacherous. When the narrative shifts from potential to the harsh reality of quarterly results, the air will come out of this bubble very quickly. Next, the monetization mirage. The trillion-dollar question over the AI bubble is simple. How will companies make money? The advanced chips and data centers required are incredibly expensive. If revenue doesn't exceed these massive costs, the entire economic model collapses. This creates a highly commoditized environment, leading to price wars and a race to the bottom. We saw this during the dot-com bust. Companies with millions of eyeballs but no revenue. When hype turns to earnings, many AI valuations could evaporate. Concentration risk. When giants stumble. The modern stock market has a dangerous flaw. It's incredibly concentrated. A handful of mega-cap tech stocks fueled by AI hype now account for a disproportionately large share of major indexes. This means anyone with a 400 to 1K invested in a standard index fund is making a massive concentrated bet on the AI boom. If these stocks stumble, they'll pull the market down with them, as forced selling from leveraged investors could turn a correction into a full-blown crash. When you listen to Wall Street talk about AI, you hear two different stories. The bulls, like JP Morgan, are all in on the revolution, but the bears see a bubble forming, warning of a painful correction. This division signals extreme risk. It's a time for caution, not blind faith. The anatomy of a tech wreck. So how does this all unravel? A tech bubble doesn't burst because of one single event. It's a chain reaction of interconnected failures. The first domino to fall is often a canary in the coal mine. A high-profile company fails to meet lofty growth expectations. Missed earnings, margin calls, forced selling, index plunge, recession. Imagine a leading AI company reporting quarterly earnings, slowing revenue growth, ballooning costs. The stock price for perfection plummets. That single event chills the entire sector. Investors begin to scrutinize AI valuations. They realize the endless growth story may have a flaw. The initial shock triggers the mechanical aspects of a crash. Widespread margin loans are a critical vulnerability. Leveraged investors receive margin calls. Forced to sell losing positions, forced to sell winning positions. Forced liquidation spreads contagion to the broader market. Trading algorithms kick in, quantitative funds and high-frequency traders programmed to sell on downward momentum. The decline accelerates, a feedback loop where selling begets more selling. The third stage, collapse of investor psychology. The AI as unstoppable narrative shatters. Fear, failure, overvaluation. FOMO flips to a desperate rush for the exits. Retail investors who piled in near the top panic. They sell to preserve what little capital remains. Media headlines amplify the panic with catastrophic loss stories. The crash feeds on itself. Fear, not fundamentals. Years of gains can vanish in weeks or even days. The tech wreck spills into the real economy. A crash can trigger a recession. Trillions wiped from household balance sheets cut consumer spending. Tech firms announce mass layoffs to conserve cash. Construction of new data centers halts. Economic weakness validates pessimism, driving further declines. The vicious cycle connects speculative mania to jobs, businesses, economic security. Now, the illusion of a healthy market. Beyond the specific bubbles in housing and technology, the entire stock market is dangerously overvalued, propped up for years by low interest rates and massive government stimulus. An illusion of health and stability. Investors have become complacent, convinced stocks only go up and the Fed will always step in. That belief is being tested. Harry Dent warns this nearly 17-year bubble could end in the worst crash in history, and stocks could lose up to 90%. Signs of excess appear in key indicators. The price-to-earnings ratio, stock price divided by earnings. Healthy levels are mid-teens. Today's S&P 500 PE is far higher, levels that preceded major crashes, 1929, 2000. Investors are paying a huge price for each dollar of profit, betting on uncertain future growth. Classic late-stage bubble optimism. Credit markets show another warning. Credit spreads are extremely tight. Investors are demanding little extra for added risk, acting like recession risk is low. This clashes with warnings from J.P. Morgan and divisions within the Federal Reserve. Fidelity calls the disconnect dangerous. When markets ignore risks, they become vulnerable to shock. Overvaluation has been fueled by heavy leverage, hedge funds and other big investors borrowing to magnify bets. Corporations piling on debt to buy back stock. Artificially inflated share prices. A rigid, fragile system looks strong on the surface, built on a precarious mountain of debt. When that cracks, the whole structure tumbles. An overvalued market can stay overvalued for a long time, but it needs a trigger to start the correction. Several potential triggers are lining up. A policy misstep by the Federal Reserve could shatter investor confidence. A sudden credit event, like a major default, could freeze lending. We also cannot discount a withdrawal of liquidity as central banks tighten. Finally, a geopolitical shock could disrupt global supply chains and spike energy prices. Any one of these could be the pin that pricks the everything bubble. While economists debate, the greater risk in 2026 to 27 is not that a recession triggers a market crash, but that a market crash triggers a recession. It's a vicious cycle. When stocks crash, household wealth is wiped out. Feeling poorer, people cut spending. Simultaneously, business confidence collapses. Companies freeze hiring and investment, shifting from expansion to survival. This feedback loop can turn a correction into a devastating depression. The passive investing trap. The dominance of passive investing presents a new risk. For a decade, money has shifted into index funds that simply buy all stocks in an index. But this passive price-agnostic buying on the way up will become passive price-agnostic selling on the way down. When investors pull their money, funds are forced to sell every stock, regardless of merit. This creates indiscriminate selling pressure, risking a massive correlated liquidation event where everything is sold at once, potentially leading to a much steeper and more severe downturn. When the world's most successful investor makes a move, it pays to listen. Warren Buffett's Berkshire Hathaway is sitting on a record-breaking pile of cash, well over $180 billion. This isn't a bet, it's a statement that he sees more risk than reward. This cash hoard is both a shield and a weapon. It protects his portfolio while preparing him to hunt for bargains when fear grips the market. His actions are a clear vote of no confidence in current valuations, trading short-term returns for long-term opportunity and safety. While some billionaires hoard cash, others are moving wealth into tangible assets outside volatile financial markets. A prime example is Bill Gates, now the largest private owner of U.S. farmland. This is a classic wealth preservation strategy. Unlike stocks, land is a finite, essential real asset with intrinsic value. This move into real assets is a defensive play, owning a piece of the real physical economy as insurance against the collapse of the financial one. In my firm, Bridgewater Associates, we've spent decades studying economic history to navigate moments like this. I warned we're witnessing a once-in-a-lifetime breakdown of the monetary and political orders. A traditional 60-40 portfolio is inadequate, reckless. My approach, radical diversification, and a deep understanding of risk go beyond stocks and bonds. Build an all-weather portfolio designed to perform in any environment. High growth, low growth, rising inflation, falling inflation. The core is balance. Different assets for different economic seasons. Stocks in high growth, long-term government bonds in recessions, deflation, inflation, linked bonds and commodities when inflation rises. Hold a balanced mix. You're preparing, not predicting. Aim for a smoother ride, minimize gut-wrenching losses and panic selling. It's a strategy of humility. Nobody knows the future. Sophisticated investors also hedge. They use options, like buying put options on the S&P 500. A put option is insurance. It pays out if the market falls below a level. This was used by Michael Burry before the 2008 crash. They also allocate to hedge funds specializing in tail risk hedging. These funds aim to generate large returns during black swan events, providing a powerful counterbalance. Prepare for the worst, hope for the best. Big investors actively insure portfolios. They see leverage and overvaluation. The risk of sudden decline is real. They're willing to pay a small price for insurance to avoid catastrophic loss. For the average investor, allocate a small percentage to hedging funds, own assets like gold, or long-term treasuries that perform when fear is high. The vulture's gambit are preparing for distress. So-called vulture investors specialize in buying the debt of companies on the verge of bankruptcy, often for pennies on the dollar, when many large firms are now raising massive distressed debt funds, preparing to pounce when a wave of bankruptcies begins. This strategy extends to real estate, where funds will buy entire portfolios of foreclosed properties at deep discounts. They know the best returns are generated by deploying capital at the point of maximum pessimism, preparing not just to survive the crash, but to profit from it. And the contrarian bet, and I was finding value, AI, the wreckage. In a market crash, big investors actively search for pockets of value that others overlook. Their job is to identify strong companies unfairly punished in an indiscriminate sell-off, the babies thrown out with the bathwater. They rotate out of expensive growth stocks and into cheaper, resilient value stocks like infrastructure and raw materials. They see the crisis not as a threat, but as a once-in-a-generation opportunity to purchase high-quality assets at discounted prices. The coming crash will strike at the heart of the American middle class's financial security, their retirement accounts. For decades, workers have trusted their 401ks, but these are directly exposed to the bubbles we've discussed. When the market crashes, values will plummet, wiping out years of savings. The problem is worst for those nearing retirement. A financial market crash of this magnitude will inevitably lead to a brutal wave of job losses cascading through the real economy. The first casualties will be in the bubble sectors, housing and tech, where projects are canceled and funding dries up. As the negative wealth effect takes hold, consumers pull back spending, creating a ripple effect of job losses throughout the service economy. This job market carnage creates a vicious feedback loop, turning a financial crisis into a prolonged economic depression with devastating consequences. In past recessions, the government could ride to the rescue with massive spending. This time it's in a fiscal straitjacket. With national debt soaring past $38 trillion, the ability to borrow and spend is severely constrained. This raises the risk of a prolonged period of economic weakness. However, a crisis also clears out deadwood. From the ashes, new sectors will rise, forming the next economic cycle. Rebuilding infrastructure, healthcare for an aging population, and green energy will create jobs. The key is to survive the storm and be positioned for the new world that emerges. We stand at a critical crossroads. One path is complacency leading to devastating loss. The other is preparation and proactive defense. This doesn't mean hiding in a bunker. It means understanding that the greatest opportunities are born from periods of maximum pessimism. The coming crisis will trigger a massive transfer of wealth, flowing from the unprepared to the prepared. By understanding these dynamics, you can ensure you are on the right side of that transfer. The storm is coming, but with the right map, you can navigate it. Please like the video and subscribe to my channel for future videos.